Hello. Good evening, good afternoon even, and welcome to Forex 101 here in the Honey Block with me, OC Edge 4. It's a bit close here. I got my guitar here. I got my Bible on the side there. It's crazy. I hope you guys are well. I hope you're all well. Let me lower the music. I hope everybody is well watching our show tonight. This afternoon even. I have got a great show for you as per usual. I'm a bit out of sorts, but I'm here. I decided to come and show my face, deliver a session, and why not? So, guys, I hope you're ready for today's show. Today's show is all about a few things that it's a difficult one today because it could get really complex and mathematical, and I don't really want it to do that. So I really want to bring you the basics of what it means to be a Forex trader, what it means to make money trading on the Forex markets as per usual. And I'm going to do that. I'm going to help you guys understand some of the principles that you may have heard of. You may have heard of certain things when it comes to trading. And I'm going to bring you some information today that really is kind of like opening up Pandora's box, kind of. Only because it can get very technical and mathematical, but I'm going to break it down for you. I'm going to make it nice and simple so that you're able to understand and follow along. So that's how it goes. How are you? Tell me where you're watching from. If you're not watching on YouTube itself, you won't be able to access the comment section. If you're not subscribed to YouTube, you won't be able to access the comment section either. So go jump on YouTube, jump into the comment section and tell me where you are watching from. Let me know, where you're from, and I'll give you a shout out, etc., etc. Because it just makes me feel like I've got people with me. I know people are watching right now. I can see that people are watching. I am also aware that some people watch via link on the mobile phone. So if you're doing that, jump on YouTube and leave a comment. I'd love to interact with you guys, especially if you have questions that you would like to ask. That is the way that I'm able to answer them live as well. So let me fade down the music. Okay. So let's get into today's session. I want to get these levels right. If you are watching, can you please, if you're able to type in the comment section, please tell me if this is too loud. Tell me if this is too loud too. Hopefully it's not. Hopefully it's the right volume. Okay, so let's get into today's session. I'm going to get into today's session. We're going to start off with a quick recap. I'm going to add this to the stream. We're going to move myself. Okay, so what are we covering today in session 15? Well, in session 15 today, we're going to be covering the recap of the last session as per usual. I've done the intro. We're going to have a look at what harmonic patterns are, and I'm only going to look at one of them specifically, but I'm going to talk to you about the fact that they exist. Okay, we're going to look at harmonic patterns. We're going to have a look at the Fibonacci sequence because it links. And some of you may have heard of the Fibonacci sequence before. Okay, I'm being told it's not too loud. That's fantastic. Love it. Right. So you may have heard of the Fibonacci sequence. I'll take you back to secondary school here. The Fibonacci sequence, we'll get into that and how it links to harmonic patterns. And this is all information that helps us to be able to identify areas within the market where we can get into some trade. And then naturally, we'll have our Forex Basics live Q&A for you all. Andrew Hart is watching from sunny Essex. That is the place to be. I'm not being biased at all, but you know, Essex is a wonderful place. It is an absolutely wonderful place. Not just because I'm here, but because Andrew Hart is watching from Essex. Shout out to Andrew. We love it. We love Essex. Right. Okay. So that's what we're going to cover. So just a quick recap of last week. We were looking at currency pairs and the cost per pip. And this is just one example that I pull out from last week's session. If you missed last week's session, as per usual, go back and watch those. If you haven't already subscribed to the YouTube channel, Edgeway Education, if you search for the channel, you will find all of our Tuesday Night Live and all our Forex 101 sessions. You can also go to edgewayedu.com and you can go to media and you will see all of the podcasts, all of the videos for everything. Okay, so and also if you go to Edgeway Education /trading, you will find all the information on Forex 101 as well. But this was last week. We were covering how much you would actually get paid per pip according to your lot size. Now, if that doesn't make sense and you are brand new to this, please go back and watch last week's session and you will understand what this means. But essentially what we're talking about is depending on the currency pair that you're trading will depend on how much money you make per pip movement. So if you're in a trade that moves 10 pips, that is great, but what currency pair are you trading? That will tell you how much you're getting. For some, it will be more than others. So go ahead and watch last week's session and that should make sense to you. It's good for you to know, even as a beginner. Okay, so what is Forex and who is involved? I'm going to keep doing this every week just so that everybody can understand, especially if you're brand new. Forex is what we're talking about when we talk about exchange of currency, foreign exchange. That's what Forex is the abbreviation for. So we're talking about the buying, selling, and exchanging of currency. That's what we're talking about. And who takes part in the buying, selling, and exchanging of currency? Well, everybody does. If you are changing your money at the cash exchange, you are taking part. Also, the banks take part, institutions take part, retail traders like you and me, we take part. And anybody who goes to the Bureau de Change, that was my best French accent. Actually, it wasn't my best French accent, I'm a bit tired. But yeah, if you're changing money at the cash exchange, you are taking part in the currency markets, and you are also the price that you get is dependent on the movement within the markets. So those are the people who take place. Banks, as said previously, banks take part because every single bank now is involved in trading. They have a trading arm, they have a trading branch where they will have people on a trading floor at computers, and they are trading the money that you've placed in the bank, and then some. And they're making lots of money. And if at all they give you any kind of interest, it's very, very minimal. Institutions are institutions like hedge funds, account management companies, where they will manage money on behalf of others, brokerage firms, etc., and they will trade on behalf of other people's funds and money. It is the largest financial market in the world, $6.6 trillion. I think it's 3.6 million that is traded every second. It exchanges hands within the foreign exchange market. Massive market, absolutely so much money to be made. But at the same time, when you are trading contracts for difference, which you are doing when you are trading in the foreign exchange market, there are also high risks involved when trading. I will always give this disclaimer because some people feel that it is a get-rich-quick scheme. It is not. It is all about learning a skill and, yes, trading with sensible risk management. I'm going to bring my face back up. Sensible risk management. Okay, so okay, so that's what trading is. So what are harmonic patterns? What are harmonic patterns? Okay, well, a man named Scott Carney discovered harmonic patterns within the markets in the late 90s. These are some examples of the patterns that he found. He first of all found something called the Gartley pattern. I'll show you what that looks like in a moment. There's also a butterfly pattern, also a shark pattern, crab pattern, bat pattern. There's so many different types of patterns. I'm not going to list them all, but this is an example of what we're talking about. He noticed that there were certain positions where the market starts and stops, and particular movements and distances were created. So in the example here, what you see in the image is what's referred to as a bullish Gartley pattern. And what a trader would do is they would look out for these specific areas where price has started from a certain point, it's reached a certain height, it has retraced back. Let me use my mouse cursor to point to this diagram. So we see market has started here, it's moved up to this point, and it's moved down, it's retraced to a specific level, and then it's gone back up, and then it's retraced again to a specific level, and then the expectation is that price will move back up. Okay, so these patterns are identified and they form different shapes, and this one is referred to as a Gartley pattern because of the structure in which price forms. So really what we're looking at, we're going to have a look at some charts in a moment to show you exactly how these things work and how they're linked with Fibonacci. But we're talking about this X indicating a specific price in the market. Going up to, oops, I've just gone backwards on the thing. Let's get it back up. So going up to A is a specific price on the chart. It would retrace back a certain distance, and that's what these numbers indicate. Retraces back a certain distance, and then it goes up a certain distance, and then down a certain distance. So all of these things are calculated ratios. This is an example of the inverse, where what we refer to as an XABCD pattern is formed. So X here, A, B, C, D, and then we would look for a sell off here, and usually the stop loss would be slightly above the X. And that is what a trader would do to look for opportunities. Thank you, Scott Carney. Now, I'm going to bring my face back in here, not because... yeah, just so that you can see me while I'm talking. So the next point that I'm going to make is this. When it comes to trading, there are certain people who feel that harmonics do not work. Okay? There are some people that feel that harmonics don't work. So all of what I'm talking about today is based on something that is called, it's based on an approach called technical analysis. Okay, so when you look at the charts, you are looking at what we refer to as price action. So price has moved from one point to another point, and again from that point to another point, that point to another point. And over time, what you will do is you will analyze where price has been to determine where you feel price could go to next. So it's using previous price to determine what future price could be. Now, there are some people that don't believe that the Fibonacci patterns and harmonic patterns are anything, because what using harmonic suggests is that patterns will repeat. So when price comes to a certain area, it will go to another area. So that doesn't actually cater for the fact that there are people involved and everybody's choosing and deciding. What it's saying is that no, even though everybody's involved, people will always do this and this will always happen. So some people actually don't follow harmonic structures, harmonic patterns. And there are two schools of thought out there. Now, what happens when people go to a chart is they will draw up lines of support and they will draw up lines of resistance, and those lines, people say, they don't have to be exactly accurate, they don't have to be spot on, but to where you feel they should go. And that's what's called drawing up dynamic zones. Okay, so these are zones that you are identifying that could move, they could be shifted slightly. When you use a harmonic scanner of any kind, identify harmonic patterns of any kind, what you're using is what's referred to as static zones. Static zones. So that means these zones are mapped out by maths, by calculations, according to specific ratios. Follow me? If you're following me, just say, yes, I get you. put it in the chat just so that I'm not losing people. Like I said, it's kind of a rabbit hole here. I don't want to get too deep, but we've got two schools of thought. Let's make this nice and simple. On one side, people say, no, I'm just going to look, and I'm going to draw up my lines, and I'm going to see how things go. The other people say, no, I'm going to use mathematical tools, and I know that when things hit here, it is going to change, and it's going to move and change direction, okay? Those are the two schools of thought. So you will find certain people who will say it doesn't work, it's a lot of rubbish, and you will find other people like myself who know for a fact that, my goodness me, this stuff is like so crazy. It's so crazy. It's crazy. It's amazing. But yes, and this is the reason why I'm showing you now. So we have here just the Gartley pattern. That's the only one I've showed you here. Like I said, there are butterflies, bats, and all kinds of different patterns. But just so that you know, this is Forex 101. We're keeping it basic. These things actually exist, and we're going to go to the charts in a moment and have a look and see what we can see. Okay, so the Fibonacci sequence, and how does it work? What is it? So what we have here is a number sequence, and you can see there on my chart. I'm going to move myself out of the way. We've got 0, then we have 1, and then we have another 1. Now, how do we get the other 1? Well, we start off with 0, and then we have a 1, and then what we do is we add those two numbers together. So 0 add 1 equals 1. Okay, and then we add the next two numbers together. Well, 1 add 1 equals 2. Okay, and then we have 1 add 2 equals 3. That's right. And then 2 add 3 equals 5. 5 add 3 equals 8. 8 add 5 equals 13, and on and on and on it goes. So this is the Fibonacci sequence. Now, if you have study this before, you'll realize that actually this pattern is found in nature. It's found in the amount of number of petals on flowers. It seems that flowers will either have 3 petals, or they will have 5, or they will have 8, or they'll have 13, etc. It's very interesting how nature follows that pattern. And also, if you were to actually plot out this Fibonacci sequence and its ratios according to drawing a diagram, let me get my face back up, what you will have is a pattern whereby you kind of create a spiral, and it goes around the outside, and then it comes inside, and then it comes in, and then it comes in really tiny. And that is the distance ratio between each pattern, between each number, creates a new, oh, goodness me. So using these numbers here, what you have is a sequential pattern that can be computed with an algorithm to draw out that spiral. And what you'll find is in the middle of flowers, and if you continue on this spiral, you kind of create these wonderful kind of petal flowery type shapes and stuff like that. And you find it in flowers, you find it in snowflakes, you find it in the formation of ice cubes. It is absolutely amazing how this thing appears almost everywhere, these Fibonacci patterns. Maribel says, so she's late. No problem at all. Always welcome. Always welcome. So these patterns occur everywhere. So why is this important? Well, what people have found is that actually the ratios between each numbers using calculations give you certain levels. And that is exactly what the Fibonacci tool does for you. Okay, so the key Fibonacci ratio is what's known as a 61.8, and that is a calculation based on when you have 13 divided by 20. I think it's 8 divided by 13 as well. Let me get my calculator and just do it. You can follow along with me as well. So let's do 8 divided by 13, see if that one works. No, I think it's a 13 divided, yes, 13 divided by 21. Let's do that. 13 divided by 21, there we go. So 0.619. So this is a 618. And then you've got 21 divided by 34, 21 divided by 34, 0.6176, which is 0.618. So this is a key number within the Fibonacci sequence, and it is used as a percentage. So when you use the Fibonacci tool, what you'll find is it gives you certain lines and certain percentages. Those lines are based on this Fibonacci sequence of numbers, and they are calculated specific percentages. So what that is doing is determining actually from one distance to another, these are the percentages as a ratio of the Fibonacci sequence of gap distance between them. So again, this kind of goes to, right, using these levels, this is where price is definitely going to go to, and something's going to happen. So either it's going to hit that place as a resistance and come off it, or it's going to hit that place as a support and bounce back up again. So that is the connection between using this sequence of numbers and the Fibonacci tool in the charts. So what has that got to do with harmonic patterns? Well, using these ratios, what happens is you can compute certain harmonic patterns to go from one level to a certain percentage, back to another percentage, to another, and to another, and then we predict a move either in a bearish fashion or a bullish fashion thereafter. Put a yes in the chat box if this is making sense. I know this is kind of, we're getting into kind of, this is maybe Forex 205 rather than Forex 101, but I am trying my best to make this as simple as possible. First of all, just know that harmonic patterns exist. They are used by traders in the market for technical analysis so that people can know their entry and where they are going to take their profit, as well as to set their stop loss. So if I go back to our previous slide again, just for those who may not have seen it. So we have one example here of a bullish Gartley and a bearish Gartley. So price has begun here, we call it X. It has gone up a specific distance to A. And then the expectation is that there's a retracement to around the 61.8 level, or we see here 1.618, 68%. We'll have a look at that on the charts in a moment. And then also, because it has gone to that level, using again the Fibonacci ratios, we're expecting it to move to another set distance ratio, the 88%, and then back again, and then up from there. And again, we have the bearish model, which is exactly the same, but inverse X, A, B, C, D. So, and you can plot these yourself. Some tools are available for people to use that have the patterns computed for you. So the computer is doing all of the calculations, and it has marked that because price has moved to certain levels, it has drawn out the pattern for you and shows you, okay, these levels have been reached according to the Fibonacci ratios. Therefore, here is your entry, here is your take profit, here is your stop loss. If that's not amazing, I don't know what you think is. But yes, that is the link between. Andrew says, yes, sort of. I know this is crazy. This is like high level stuff, but I'm trying to make it simple. Because the reality is, okay, why am I sharing this with you? Okay, because we have a lot of tools at our disposal. When we come to trading in the charts, we can go to TradingView, which we're about to do right now, and we can have a look at charts, and that's great. That's fantastic. It's amazing. Now, when we look at these tools, we can have confidence or not, depending on what we know at a basic level. So understanding these things, I think, are crucial, because once you understand that actually these levels are according to mathematical calculations that give you specific levels, and also when you plot those lines, okay, and you look back, you just put your chart into the 4-hour view and just check back and see where those lines hit, you will see historically that those lines have always been respected as places of support and resistance. So what does this mean for human thinking? Okay, well, yes, a person is still able to go into the market and decide to buy and decide to sell. Of course, they're not bound by the Fibonacci sequence, but however, what is the first thing that people do when they do technical analysis? Well, they look at previous price. That's exactly what the indicators do. They look at what has happened before in price. So when you're looking at it as a person, you will decide what is a fair price to buy and where is a fair price to sell. So it's kind of one of those chicken and the egg things. When you're looking at it, you're saying, okay, well, are you saying that you are always going to trade and you're just following the Fibonacci sequence? Well, possibly, but also the fact is, whenever you look at those levels, those zones where price is, it reaches a certain point, it's highly unlikely that you're going to do the opposite of what price has done previously. So if you're going to do what price has done previously, then it follows that actually you can use that information to compute and calculate. And this is what all of these algorithms are based on. People will look at the charts, look at previous price action, they will do back testing, and they will compute a specific algorithm to say when price gets here, we are going to do this, that, and the other. And that's how it works. Hopefully that is as clear as mud. Is that clear? I'm going to give myself a round of applause. I don't know if it's appropriate. I'm just having fun here. So yes, again, this is how this Fibonacci sequence, and we know this from maths lessons, is the two numbers added together gives you the next one. Those two numbers added together gives you the next one, and so on and so forth. And the distance between those as a percentage is how we get our ratio. So let's get on to trading view. Let's get on to trading view. Let me just open this up. How are you guys doing? You're right. Is everybody still with me? You guys still with me? Thank you so much, Maribel. She's always so supportive. I love it. Thank you. Okay, let me get a trading view up. Get the chart up. Do you know my computer is on its last legs? So it's last legs. I said it properly. Anyway, my computer is on its last legs. And it's really running slowly. Okay, here we go. So I'm going to stop this screen. I'm going to share this screen. I'm going to show. Okay, so let's get this up. In fact, let's just share the entire screen of this screen so that I can flick back and forth between the two. Okay, so you can all see my screen here. So let's have a look at this in, well, I say in action. I'm just going to use the XABCD tool just to show you what I'm talking about in terms of predictive harmonic patterns. Okay, so if I get the XABCD tool, which is here, okay, so I can look at, excuse me, a specific area. And I see the price high. And that will be the X. I will see the price log of the lowest point. And then that will be the A. And then it comes up to this point, B. And then down to here again, whoop, C. And then D. And then you would expect the drop off from there. So where X is, it goes the opposite direction. Remember that. So if you start off with X at the bottom, X, A, B, C, D, you're expecting price to go up. You start off with X at the top, you're expecting price to go down. And you can see here, X, A, B, C, D, price has dropped off, fallen off and gone down. It's respected this area here. It's gone to here. And then it's kind of bounced back up to go up again. Is that making sense? 30-day free trial, no thank you. Type a yes in the chat box if that makes sense. Look at previous price, decide fair price and pay, use the same information to calculate when price is right to enter. That's exactly right. Look at previous price, decide a fair price to pay, and use the information to calculate what price is right to enter. That's exactly right. That's exactly right. Thank you for that, Maribel. So this is an example of how a trader could use a harmonic tool to draw out a harmonic pattern. Okay, now some people go from the body, some people go from the wick. I'm not going to say anything further beyond that. I'm not going to tell you what to do. You know what to do if you want my actual advice. Now, let's have a look at something here. So we spoke about this. Now let's get rid of this. And let's have a look at the Fibonacci. Oh, sorry, that's the, what do you call it? That's the, what do you call it? Thingy. It's in here. Where is it? There we go. I got my Andrew's pitchfork up. Fib retracement. There we go. So going from a high to the low. In fact, I'm going to drag this out a bit, just at that level, just to show you what we are talking about. And I'm going to get rid of these lines. I apologize for these lines of previous markups that I've done. I could always do them again. Get rid of this. Get rid of this. Get rid of this. Lovely. Right. Okay. So. Right, in fact, you can't really see that. Let me delete this. We go from low to high. We should be able to see it from low to high. And I'm going to spread this out just over here so that you can see it, hopefully. I'm making my mouse level with the top of this week, by the way. Okay, let's close this. So here we can see we have the 0 level. Okay, then we have a 0.382, that would be 38%. 0.5 would be 50%. And what we see here is 0.618, which is 61.8. And then we have a 78% level. And then we have a 100% level, which is 1. Now, when we take 0 from the high, we're looking for a retracement back to this area for a move up. So when we have the 0, we're going the distance from that 0 to calculate our percentage levels. That's what we're looking for. Okay, so what we can see from here is taking the top of this wick. Some people might take it from the body, the body. But what we can see here, hopefully, is that price has moved from here. And if we look at this 61.8, it's actually gone to 78%. And then it has come back up to a certain level. And then it has come back down again to a certain level. Then it's gone up again from there. So this is very, very much so linked with what we were just talking about now with the XABCD. And it's going to get very messy if I put the XABCD pattern on top of it. But it's just to let you know that this is how, when a scanner is scanning the market, how it's calculating those distances. It's using these percentages. So rather than it looking at the chart and saying, oh, it's there, this price, and it's there, that price, actually, it's knowing, yes, it's at this price, but then price has moved a specific percentage distance away, and then another specific percentage distance and come back, etc. And that's how those patterns are calculated and formed based off these levels. Now, what I want to do is, I've just picked, I'm not even looking at this with much effort. I'm just kind of putting it down just so that you can see what's happening. But I'm going to put a line here on the 38%. Again, this is random. We're going to put another line here. I'm going to put another line here. And I'm going to put another line here. And now we're going to have a look at an expanded view of the chart. Okay, so these are Fibonacci levels, and we haven't really done, we haven't really done much, we haven't taken much care in terms of looking at where we place it. I've just taken it from the high that we're down to the lower region. Now, we've got these lines here. Now, let's have a look back and see if price has been respected any of these lines. Well, we can see here, price came underneath here, and we can see it's created a ceiling here. It's created a floor there for this one. It's created a ceiling here and a ceiling again. If we go further back, we can see something's happening around here as well. See something's happening around there too. Let's go back even further. Okay, so it's created a floor here. Again, it's created a floor here. It's gone to this level here. It's bounced up. Can you see how price tends to respect these, so well, not tends to, it does respect these. And look at this one. It's come all the way down to this level. It's reached that level and shot up again, and it stopped at this level. So we can see here, this can create certain entry points for a trader to say, right, okay, it's broken through this line. Let's take a trade maybe to here or to here or to here, and they know where to take their profit. And we're having a look here. We can see it's created a floor here. Let me close this. It's created a floor. And here again, this line here, it's created a floor. It is very interesting. It's very interesting. It's always creating a ceiling here almost. For price here, it's just, this is just shy of it. Again, it's created a floor here. See this wick went and touched there, came away. Again, price here. Oops, I think I just moved one of the lines. Oh, let's just move it out of the way. But we can see here it's created a ceiling there. That's what happens when you're doing things live. And again, the wicks, look at that. Look at the wicks coming up there. And then it's trying to ceiling floor. Goodness me. So we can see how just by plotting the Fibonacci tool and extending those lines, we can see how historically something happens when price hits those areas. It's either a ceiling or a floor. And there are approaches that will more accurately, naturally, I just kind of threw up, I would say I just threw up the Fibonacci tool without much care or attention, just to show you how it works. But there are strategies where you will use it more accurately, with more precision, to find out where to place lines of support and resistance. But Fibonacci tool linked with, well, that's how harmonic patterns are formed. And that is how we're able to spot good zones of entry, good places for take profit, and good places for stop loss also. And this in conjunction with other things like convergence, divergence, confluence, etc., will help a trader to be able to take a trade. Okay, guys, Q&A time. If you have any questions, please type them in the chat box. If you want me to repeat anything, if anything was not clear from what I've said, if, yeah, just anything, just let me know. Let me know. Let me know what you think. I'm hoping, it is my hope and intention that this session has helped somebody who is watching to understand what is going on behind these patterns and why these certain levels are important. Now, certain people will create their own zones using the XABCD pattern, and they may have misidentified where those zones are. Here's how to more accurately look at it. So what you need to do is kind of keep in mind the specific percentage ratios that you're looking for, and know that actually Gartley, bat, butterfly, shark, all of these are formed based on specific numbers. So if you're not sure, you can actually double check what you've drawn up against those numbers, against those specific ratios, using the Fibonacci, and see, oops, actually I need to readjust my C. I need to readjust my D line, because actually this ratio percentage should be here. And that will help you to be a lot more accurate when you're drawing your own XABCD harmonic patterns. Okay, so fantastic. I am glad this has helped. I'm glad this has helped. I'm so glad. So guys, if you know, we got through it, because I'll tell you what, this session it's not an easy session to deliver, just based on the fact that I know that it can get very complicated. And sometimes when we hear maths, we want to run for the hills, but hopefully I've explained it in a way that is helpful, that is clear, and at least I've helped one person. That's you know, that's my job done. I guess I've helped somebody. So that's great. Guys, if you have any questions, please drop them in the chat. If not, I'm going to sign out, because like I said, I'm tired. I don't know what it is. Well, I do know what it is, but I don't want to talk about it. There's all kinds of stuff going on in my personal life. But surely that won't bother you. Andrew Hart, I'm so glad. Yes, because you were on for the start. You weren't grasping it. You said yes, sort of, before, but now you say it helped a lot. Fantastic. Well done to you, sir. Okay. Guys, I'm going to head out. I really am. I'm going to head out because I'm tired. But I am so glad that you found this useful. Thank you so much, Maribel. appreciate it. I'm here to serve. I'm so happy to help you all. I hope you found it useful. Let me do my closing spiel. So, if you would like to start learning via Trading Academy, you know what to do. Contact the person who invited you to watch the session. If you have just stumbled upon the session, just perchance, by chance, then what you need to do is visit edgewareedu.com/trading and click the Start Now button, which looks exactly like this, that thing right there. And then if you need more information, you can sign up to the mailing list and you can receive more basic trading tips and watch previous sessions on the Edgeway Education YouTube channel. If you're here already, don't forget to hit the like button and subscribe to the channel. And I hope you guys have yourselves a wonderful, blessed week. You will catch up on the start of the recording. That is great. And anybody who missed the start of the recording, go back and watch it as well. Hopefully it will be helpful. And watch previous sessions as well. And as per usual, join me for more Forex 101 next week. And also don't forget my Tuesday night live session that I have interviewing entrepreneurs each week. This week we have none other than Dr. Rashada Harry, who will be talking to us about your future, your ambition. So tune in for that. I hope you guys have yourselves a wonderful day. Thank you so much, Facebook user. Good stuff, son. I'm impressed. Son, I'm assuming that might be my mummy. Hello, mummy, if it's you. If not, then thank you. Person who call me son. Like it. It's nice. I don't mind people calling me son. It's good. Guys, have yourselves a great week. Take care. Be blessed. And I'll see you next time on FX 101. Take care, y'all.